Hello, welcome to the Capital Overview. In the past two segments, I shared information on revenues and expenses. In this segment, we will look at capital expenditures, sometimes referred to as CapEx. What are capital expenditures and why are they important? Our major assets sometimes are referred to as plant, property, and equipment, or in layman's terms, our buildings, our grounds, and other investments. These all comprise our infrastructure to carry on the teaching, research, and student activities on our campuses. The purchase of an asset for over $5,000 is considered to be a capital expenditure. These expenditures do not appear on our income statement, and thus a revenue and expense budget will not capture these planned or unplanned expenditures. If these capital expenditures are not on our income statement, where do the funds come from to build and improve our physical plant? These funds are generated from both external and internal sources. First, let's look at the external sources. There are three main types of external funds. The first source is from state government. We can receive funding from line items in the general fund appropriation process. This was the major source of new capital investment for colleges and universities through most of the last century. Funding of capital assets through this avenue were significantly curtailed throughout the nation over the last 30 to 40 years. A recent example of this type of funding would be the $10 million Idaho State University received for expansion of the Eames complex. In Idaho, we also receive special appropriations through the Permanent Building Fund, which is replenished through 7 statutory sources such as lottery sales and cigarette taxes. These funds are for specific projects identified by the university, primarily focused on ADA compliance and on alterations and repair. This source of funds ranges from approximately $2 million to $6 million each year. These funds are distributed and regulated by the Permanent Building Fund Advisory Council, otherwise referred to as PBFAC. The second external source of funding comes through philanthropy. A recent example of this is a gift that the university received to restore the eye on Red Hill. The third source of external financing is borrowing. This comes in the form of proceeds from the issuance of debt through the sales of bonds. ISU completed a sale of approximately $20 million of bonds last fall to finance the expansion of the Meridian campus, upgrade the residence halls, and renovate Davis Field. Internal sources can come from ISU's reserves or cash in the bank, and it can come from operations. All of the external sources of funding for capital projects, as well as the use of reserves, are one-time in nature and should be used for capital expenditures over and above the dollars available for capital expenditures, which are generated from operations. I would like to turn our focus to the operations component for a few minutes. Capital from operations. What does this mean? Well, let's follow the money. In the following example, we will look at both a bank account and a simplified income statement. Let's assume we are starting with $0 in the bank on day one. And in this example, we receive revenue from both the state government and our students in the amount of $100. We then deposit the money into the bank, raising our balance to $100. Next, we need to pay our faculty and staff, and our personnel expense is $70, requiring a withdrawal from the bank and lowering our bank balance to $30. We also have to pay for utilities, supplies, and other expenses in the amount of $10, drawing our balance down to $20. Our adjusted income is now $20. However, we still need to account for a depreciation expense of $20, which brings our net income to 0 or break even. But wait, did I forget to reduce our bank account by $20? No. Depreciation is a non-cash or book entry and does not require a cash withdrawal of $20, leaving our $20 in the bank. Let's now add capital expenditures to our discussion. If we also spent $20 on capital, we would now reduce our bank account by $20 and would be back to a zero balance. However, if we only spent $10 on capital items, we would end the year in a break-even position on the income statement and still have $10 in the bank. Why is this important? If we integrate our budget or our plan for our income statement with our capital budget, we will then be able to optimize the amount of capital we are investing each year. Let's look at our ISU experience since 2012. The orange line on this chart represents the amount of capital we have spent in each of the past 8 years. Capital that we have self-generated from our operating position. It has ranged from a low of $4 million to a high of $10 million, with an average of $8 million per year. Let's now look at the green line. The green line depicts the depreciation expense over the same time period, of which we've had an average of $12.5 million a year in depreciation expense. Based on these two lines, it is obvious that we have been clearly underspending on capital improvements. Based upon what we learned in the previous slide, the area between these two lines represents cash that we have accumulated rather than investing in our physical plant, property, and equipment. This represents $35 million of our current cash reserve balance. By definition, a university does not have to commit all of the depreciation expense toward the investment in capital assets. The senior leadership team may make a strategic decision to underinvest in capital and invest in other initiatives. But in our case, the dollars were neither invested in capital nor invested in strategic initiatives. While some may argue that we now have a source of funds available to make strategic investments, the result of the failure to have not invested an appropriate level of cash from operations can be seen in the following chart, which we provide to the State Board of Education as part of our annual university ratio analysis. This chart depicts the trend of a financial ratio known as the life of capital assets. This ratio is an indicator of the age of our physical plant. Our governing board's benchmark for this ratio is 10. A number higher than 10 indicates that we are underinvesting in our assets and more money will be needed in the future to address an aging campus. In terms of the performance of this ratio, from 2009 to 2013, we were at roughly 13, which was already above the board benchmark of 10. However, if we look at the period from FY12 to FY19, we have increased that ratio by 40% to 18.3, which is nearly twice as high as the board approved benchmark. The trend of this ratio signals to many of us what we have already physically seen about the condition of our physical assets on campus. So what are the takeaways from this update on capital? First, proper fiscal planning requires an integrated revenue, expense, and capital budget process so leadership can make decisions to optimize our deployment of assets and ensure that the budget is supporting the strategic goals of the institution. Second, our level of depreciation expense should be our bare minimum in capital expenditures for renewal and replacement, without regard to the other external sources of capital investment. Some institutions have policies that set the capital budget at 105 or 110% of depreciation expense. The age of our campus assets are growing, and our deferred maintenance backlog is growing. And finally, we have been underinvesting in our capital assets. Thank you for watching this segment in our series on the financial components of our operations. And feel free to contact me with your questions, comments, and observations at the following email address: finance@isu.edu.